Imagine applying for a business loan tomorrow. The bank reviews your application and says the loan is approved. But there's one condition. They require a personal guarantee. At that moment, many founders ask the same question. If the business exists, why does the bank still want me personally responsible? That question reveals something important. Because a personal guarantee is not just a contract term. It's a signal about how the bank sees your structure. And we'll examine how lenders interpret structural independence and why some businesses receive loans without guarantees while others don't. Because personal guarantees are not random. They appear when the lender believes the business may still depend on the owner. If the business can't repay the loan, who ultimately absorbs the loss? The company or the individual behind it? If the lender believes the company itself can absorb that pressure, the loan may stand on its own. If the lender believes the company still depends on the owner, the bank transfers the risk back to that owner. And that transfer happens through personal guarantee. And if authority, financial stability, and decision-making appear concentrated in one individual, the bank recognizes a dependency pattern. The entity exists, but the business appears to rely heavily on the owner. That increases uncertainty. Think about renting an apartment. You walk in, confident, but the landlord says, "We still need a cosigner." Why? Not as a penalty, not because your story is bad, because if something goes wrong, they want someone else on the hook. That cosigner is the backup plan. If you don't pay, they will. That's exactly what a personal guarantee is. The business applies for the loan, but the bank is thinking, what happens if this structure doesn't hold? So they add you. Not as a partner, not as a helper, as the fallback. If the business fails, you pay. The bank isn't evaluating confidence, they're evaluating exposure. And when they see new entities, thin operating history, unproven structure, they don't reject you. They pull you back into the deal. Because your structure didn't fully carry the risk on its own. Banks also examine financial behavior. Does the business generate stable revenue? Does it maintain reserves? Or does the owner regularly inject personal funds into the operations? If the owner repeatedly stabilizes the business financially, the bank recognizes that the business may not yet sustain itself independently. And that pattern increases the likelihood of a personal guarantee requirement. Another signal comes from credit history. Businesses with established commercial credit profiles demonstrate financial independence. Businesses with little credit history may rely more heavily on the owner's personal credit. When the lender sees this dependency, it may require the owner to guarantee the obligation. At this point, many entrepreneurs recognize something important. The personal guarantee is not a punishment, it's a transfer. Risk that should stay in the business gets transferred to you. It's a response to the uncertainty. The lender isn't trying to prove that the structure fails. The lender is protecting itself in case it does. And that protection shifts risk from the business back to the individual. Personal guarantees transfer responsibility in a very specific way. If the business defaults on the loan, the lender can pursue the guarantor personally for repayment. From the bank's perspective, this resolves the risk question. If the business succeeds, the loan is repaid normally. But if the business fails, the guarantee ensures the lender still has recourse. Think about standing in the rain with a small umbrella. From a distance, it looks like you're covered. You've got protection. You have structure. But then the rain gets heavier. The wind shifts. Water starts hitting your shoulders. Then your back. Then everything. The umbrella didn't fail completely. It just didn't cover enough. So what happens? You get wet. The business structure is the umbrella. It's supposed to take the hit, contain the exposure, keep things separate. But when the structure isn't strong enough, the bank doesn't pretend you're covered. They step in and say, "We still need you under this." That's the personal guarantee. And what it really means is that the pressure didn't disappear. It just reached past the structure. It's now touching you. And if you're launching a business, understanding guarantees early helps you recognize how institutions evaluate structural independence. As businesses mature and demonstrate stability, lenders may become more comfortable reducing personal guarantees. And if you're already operating a company, guarantees can serve as diagnostic signals. They reveal how lenders currently classify your business. Because institutions rarely explain their reason directly, they simply adjust the terms. Personal guarantees reveal something many founders never realize. Institutions evaluate businesses differently than entrepreneurs do. Founders focus on opportunity. Institutions focus on responsibility. And when lenders require personal guarantee, they're revealing their interpretation of the structure. They're signaling that the business alone may not yet absorb the risk. Understanding that signal helps founders see their company the way institutions see it. Because the real test of business structure is not formation. It's where responsibility ultimately lands when the pressure appears. If this gave you a different way to think about your structure, then like the video and subscribe, because most of what's out there is focused on formation, not what actually holds under review. And if you're already operating a business, then there's a free resource in the description called the Structural Exposure Check. It's a simple way to see whether your business is actually separate or just documented that way. And remember, structure isn't what you file. It's what survives under pressure.